Hi, we will be discussing the monetary policies of Australia. The Reserve Bank of Australia is responsible for formulating and implementing monetary policies, which involve setting the interest rate on overnight loans in the money market. The Reserve Bank Board consists of Governor, Deputy Governor, Treasury Secretary and 6 external members who on a monthly basis make a decision about settling the cash rate. Speaking about the objectives of monetary policy, reducing the unemployment rate comes on the top. The unemployment rate increased slightly in late 2016 to 5.8%, which is around its level of a year earlier. Employment rose modestly in the December quarter, but to maintain a full employment would be main objective. The other objectives would be stability of currency and economic prosperity and welfare of the people of Australia. Talking about inflation, the inflation remains quite low. Headline inflation was 0.5% in the December quarter and 1.5% over the year, as had been expected. Underlying inflation was little changed at 1.5% over 2016. We are looking to achieve an inflation rate of 2 to 3% on an average. It also serves as an anchor for private sector inflation expectations.
To implement the objectives, let's look at the cash rates and the interest rates. Cash rate has a powerful influence on the interest rates of Australia. Bank's domestic department has the responsibility of keeping the cash rates at a constant rate, which prevails around 1.5 to 2% currently. Changes in this cash rate may affect interest rates. Interest rates currently are prevailing around 2 to 3%. Let's see how this works. If RBI supplies more funds, the commercial banks will shed funds by lending more cash, which results in cash rates to fall. However, if RBI supplies less, then banks hold and borrow more, which results in increase in the cash rates. Now let's look at the market operations. RBI tries to keep the cash rates consistent with demand. RBI deals with banks through exchange settlement accounts, whereas banks deal with the public in terms of loans and deposits. To raise account balance, there are various methods. Either RBI buys government bonds, or government makes outlays, or bank returns banknotes. Whereas to lower the account balance, either RBI sells government bonds, or government receives revenues, or RBI issues banknotes. Let's see the relationship between debt management and the monetary policy. Both are two different entities, as the debt management is looked after by the Treasury, whereas the monetary policy is looked after by the Reserve Bank of Australia. To overcome this mismatch, the Treasury keeps cash balances with the Reserve Bank, which acts as a buffer. Let's also see the relationship between the bank and the government. The Reserve Bank of Australia decides on the interest rates that are to be charged, and it does not allow any orders from the government to change the interest rates. It's just the consultation that is taken from the government of Australia.
Financial stability. The Reserve Bank has a role both in mitigating the risk of financial disturbances that may have systematic consequences and maintaining the stability of the financial system. The responsibilities of RBA include to smoothen flow of funds between savers and investors, support economic growth, safe and robust financial market infrastructure, coordinate with financial regulators, and crisis management capabilities including liquidity support. Foreign exchange. The RBA holds foreign exchange reserves to support monetary policy and government banking. Income earned on reserves is paid over time to the Australian government. The RBA intervenes in foreign exchange market if market conditions are disorderly, and in case of clear overshooting, that is large movement not supported by fundamentals. The RBA does not target a particular level of exchange rates. Australia has a floating exchange rate. The most common measures of the Australian dollar exchange rate are the bilateral exchange rate against the US dollar and the traded weighted index TWI. Current situation Feb 2017. Near-term prospects for global growth as being more positive, RBA has recognized the risk from policy uncertainty in the medium term. Stronger growth had contributed to higher inflationary pressures. Fall in GDP in September quarter had reflected some temporary factors. Consumption growth was expected to be stronger than the subdued outcomes in the middle of 2016. Labor market outcomes had been mixed, and as a result, there was uncertainty about the momentum in the labor market. Conditions in housing market varied considerably across the country. Inflation outcomes for December quarter were much as had been expected, and there had been very little exchange to forecast for inflation. International conditions. Fluctuation in the exchange rate affect the economy by changing the relative price of domestically produced and foreign produced goods and services. From the point of view of monetary policy management, exchange rate fluctuations are important in two ways. Firstly, they directly affect the price level. For example, a depreciation of exchange rate makes imported goods more expensive, and since imported goods make up a significant proportion of domestic spending, this will have an effect on average price of goods purchased. As we take a look at international exchange market, we can see that based on recent trends, global equity markets rallied strongly over the final week of 2016 as the US election results generated considerable investor optimism around the outlook for corporate earnings. As explained in the graph 3, the US election results weighted on most emerging markets. The asset markets of countries with significant US dollar liabilities or trade exposures to United States have generally underperformed and their currencies have generally depreciated. Domestic conditions. Monetary policy increases or decreases the money supply in an economy. The change in the money supply is mirrored by an equal change in nominal output or gross domestic product. In addition, the changes in monetary supply will lead to a change in consumer spending. It also affects the household and labor sector. As seen in the graph, the GDP fell in September quarter, reflecting some temporary factors. Consumption growth was subdued in mid-2016. It is expected to recover but remain below its historical average. The household sector. As seen over here, the modest pace of real household disposable income growth over the past year has weighed on the consumption growth. Although low interest rates and rising household wealth have generally supported household spending. The labor market. Following strong growth in 2015, employment growth moderated over 2016, consistent with slowing in domestic activities.
The Australian payment system is governed by both Commonwealth and state legislation. The Reserve Bank of Australia has the explicit responsibility of regulating the payment systems in Australia with the assistance of several intermediary bodies. The Australian Payment and Clearance Association administers 6 payment frameworks, including checks, direct entry, cards, and high value payments. APCA administers the bulk electronic clearance system to monitor internet transactions and direct payments of debit and credit. The high value payments include payments between banks and other financial institutions, either for themselves or for corporate customers. It accounts for nearly 90% by value of total payments made on a daily basis. The high value payments are regulated by the high value clearing system with a mechanism called the Swift Payment Delivery System, and each payment is settled individually through the Reserve Bank Information Transfer System or the RITS. The RITS also takes care of the cash lag of debt security settlements and foreign exchange transactions.
The low inflation outcomes over the past years reflect weak labor cost growth, low inflation expectations, and low rent inflation due to increase in the stock of housing. The earlier large depreciation of the exchange rate is no longer estimated to be putting upward pressure on tradable prices. As per the consumer price inflation graph, we notice that the headline inflation was around 1.5% over the year. The second graph to the right depicts that measures of underlying inflation were around 0.5% in the December quarter and around 1.5% over the year. This was pretty much in sync with the forecasts in the November statement. Prices for tradable items declined in the given quarter and also over the year. The effect of heightened competitive prices on inflation is expected to wane over time, although the point at which this will occur is still a questionable thing. Coming down to non-tradable inflation, it increased a little in the December quarter, but remains below 2% over the year. It continues to be weighed down by domestic cost pressures and downward pressure on rent growth from the increase in housing stock. Wage growth too was low and slowed further in the September quarter. The following graph shows the GDP forecast based on this. Even excluding telecommunications, equipments and services, market service inflation is low compared with its history as depicted by the graph on market services inflation. With respect to rent inflation, it declined a little further in the quarter and in year-ended terms in around levels last seen in mid-90s. It was also observed that the increase in supply of new housing has been putting downward pressure on rents. Measures of inflation expectations remained low, consistent with recent outcomes for CPI inflation. The recent trend in short-term inflation expectations is mixed across the different measures as shown on the graph. The graph on the long-term inflation shows that expectations remain the same around the inflation target. As per the table, we notice that the forecasts for GDP growth are lower over the next 3 quarters than those presented in the November statement, almost entirely due to the base effect of the weak September quarter. The profile for consumption growth has been revised a little lower over the forecast period, reflecting a view that consumption growth is unlikely to run materially ahead of household income growth over this period. The following graphs also show the GDP growth forecast at 70 and 90% intervals respectively. There also prevails high uncertainty about the current momentum in the labour market and how this will translate into growth in wages, household income and consumption.